Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 160, and in this episode, we are reviewing the performance of the global markets during the 20th week of 2025, and that is from Monday the 12th to Friday the 16th of May. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off with the latest developments in the ongoing tariff war, where on Monday this past week, the United States and China agreed to suspend most tariffs in a move that helped to ease trade tensions between the world's two largest economies. U.S. Treasury Secretary Scott Bessent confirmed that both countries had reached an agreement to suspend tariffs for a period of 90 days and to substantially reduce their tariffs by 115%. The trade agreement means that the tariffs between both countries will be cut from 125% down to 10%, with the exception of Chinese imports relating to fentanyl, which will continue to attract an additional tariff of 20%. The news of the trade agreement helped to boost market sentiment, with the Nasdaq futures rising by 3.7%, whilst the S&P 500 futures were higher by 2.7%, and the Dow was up by about 2%. Meanwhile, the US dollar index, which measures the value of the dollar against a basket of 6 currencies, also rose by about 1%. Staying in the United States, a report from the Labor Department showed that the rate of inflation came in slightly lower than expected in the month of April as President Trump's tariffs began to impact a slowing U.S. economy. According to the Bureau of Labor Statistics, the Consumer Price Index, which measures the cost for a broad range of goods and services, these rose by a seasonally adjusted 0.2% for the month, putting the 12-month inflation rate at 2.3%, which was the lowest rate since February 2021 and was a tad bit lower than the consensus forecast of 2.4%. And excluding volatile food and energy prices, the core consumer price index increased by 0.2% for the month, whilst the annual rate of inflation came out in line with the forecast at 2.8%. And in related news, the rating agency Moody's has downgraded the United States sovereign credit rating to capital A small a1 and cited the growing burden of financing the federal government's budget deficit and the rising cost of rolling over the existing debt due to high interest rates. The decision to lower the United States credit rating is expected to lift the yield that investors demand in order to purchase U.S. Treasury bonds and could dampen the overall sentiment towards U.S. financial assets. The United States is running a massive budget deficit, and according to the Congressional Budget Office, the federal deficit in 2024 totaled to $1.8 trillion, which is equivalent to 6.4% of the country's gross domestic product and adds to the national debt, which is now approaching $37 trillion. In the foreign exchange market, the US dollar index, which measures the value of the dollar against a basket of 6 currencies, this rose by 0.3% to 101.08, and the value of the US dollar was up by about 0.7% this past week, which would mark its biggest weekly increase in about 2.5 months. According to LSEG data, markets are currently pricing in about a 66% chance that the Federal Reserve will implement its first rate cut of 2025 during its policy meeting in September. On Wall Street this past week, stocks made a strong comeback during the week after the US and China reached an agreement to suspend tariffs for 90 days, which helped to ease investor concerns about escalating trade tensions and the risk to global economic growth. The S&P 500 posted a sharp weekly gain as investors looked past the disappointing consumer sentiment data as the broad market index surged by 5.3% to end at 5,958, whilst the Dow Jones Industrial Average gained by 3.4% for the week before settling at 42,654. And last but not least, technology stocks had a strong week with shares of Nvidia gaining by about 16%, whilst Apple rose by 6%, and Microsoft popped up by 3% as the tech-heavy Nasdaq Composite increased by 7.2% this past week to eventually close at 19,211. In the U.S. bond market, the yield on the benchmark 10-year Treasury bond edged lower on Friday as investors absorbed a disappointing consumer sentiment reading that showed a spike in inflation expectations. According to the report, consumers now see inflation rising by 7.3% over the next 1 year. This data comes after the US and China reached an agreement to suspend tariffs for 90 days, easing fears of a global trade war and a slowdown in global economic growth. On Thursday, the Federal Reserve Chairman Jerome Powell warned that long-term interest rates will likely remain higher given the frequent policy changes affecting the U.S. economy. In response, the yield on the 10-year Treasury bond briefly spiked above 4.5% before declining to 4.44%, whilst the yield on the policy-sensitive 2-year Treasury note ticked up by 2.6 basis points to settle at 3.99%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the crude oil market, the price of oil rose more than 1% on Friday, posting a second consecutive week of gains, mainly due to the easing trade tensions between the United States and China. In addition to that, President Trump announced that the United States was nearing a nuclear deal with Iran. The prospect of a nuclear deal would help to lift the sanctions against Iran and enable the country to increase its oil production that could result in an additional supply of around 400,000 barrels per day. In response, both benchmarks fell more than 2% in the previous trading session before bouncing back on Friday, with the global benchmark Brent crude rising by 1.3% to eventually close at $65.41 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this gained by 1.4% to settle at $62.49 per barrel. In the precious metals market, the price of gold dropped more than 2% on Friday and was on track for its worst week since November, as increased risk appetite from the US-China trade agreement weighed down on the bullion market. The easing of trade tensions between the US and China has revived risk appetite across the financial markets and prompted profit-taking, especially in the gold market. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. Escalating trade tensions had driven the price of gold to a new record high of $3,500 in April 2025. However, as trade tensions have abated, the price of spot gold fell more than 4% this past week to settle at $3,188 per ounce. In the cryptocurrency market, Tuesday was a watershed moment for the crypto industry as Coinbase became the first cryptocurrency exchange to be included in the benchmark S&P 500 index. Following its inclusion in the S&P 500, the shares of Coinbase soared by more than 24% based on the fact that institutional investors who track this index will now automatically add this share to their portfolios. S&P Global said that this move marks a major milestone for the crypto sector that was once restricted to the fringes of the financial markets. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week the Kenya shilling remained unchanged versus the US dollar. And according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.25 compared to 129.27 that was recorded the previous week. Meanwhile, the sterling pound was priced at 171.60 and the euro was valued at 144.72. And on the regional front, one Kenya shilling was changing hands for 28.26 Ugandan shillings and 20.77 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.94. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any exogenous shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $127 million for a grand total of $10.16 billion, which is equivalent to 4.5 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the interbank market, during the past week, the interbank market was sufficiently well-funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was 5 basis points lower at 9.85% compared to a rate of 9.90% the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 17.4 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 15th of May, and the central bank received bids totaling to 43.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 179%. The central bank ended up accepting a total of 37.4 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1 basis point to average out at 8.36%, whilst the 182-day rate declined by 1.7 basis points to level out at 8.58%, and the 364-day rate remained unchanged for the third week at 10% flat. Up next is our topical issue, and this week we're looking at diaspora remittances. The inflow of remittances in the month of April 2025 amounted to about $423 million, which was a 6.4% increase from the $397 million that was received in April 2024. Meanwhile, the cumulative inflows for the 12 months to April 2025, these increased by 12% to $4.99 billion compared to $4.45 billion for a similar period in 2024. The sustained inflow of remittances continue to support Kenya's current account as well as the domestic foreign exchange market. Official data from the Central Bank of Kenya indicates that during the period under review, the inflow of remittances from Australia were the fastest growing, and during the first 3 months of 2025, remittances from Australia increased by 71% to hit about $56 million. Meanwhile, remittances from the United Kingdom declined at the steepest rate of 30%. down to about $78 million in the first quarter of this year. The United States remains the largest source of remittances, accounting for about 56% of total remittances received in April 2025, and recorded total inflows of about $652 million for the first 3 months of 2025. Since 2015, diaspora remittances remain the largest source of foreign exchange into Kenya, having overtaken other traditional sources such as tourism and agricultural products like tea and coffee. And on that note, we come to the end of this week's podcast. And thank you for listening to the Market Color podcast. I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, a brand is what people say about you when you leave the room. Think about it. Thank you, and God bless.